What if I was to tell you that the next 2 weeks is going to be the most important of 2025? Will we go down the recessionary path or potentially continue up higher? Well, depending on market structure, this is going to matter. And now that we've closed below the daily 200 moving average, time is of the essence. In today's video, we'll take a look at the data, the most traded levels, and of course, the options flow to try to figure out what exactly is going on right now. Are things going to hold at these levels? Let's find out as we go through stocks, commodities, and cryptos. Let's first begin though with a big number, six consecutive days of plus or minus 1%. What does this mean? Well, of course, we've got a volatility on the horizon, but at the same time, it's usually telling us that there is still more to come. The next 2 weeks to 1 month later could be up, down, and all around as we try to navigate exactly what has happened. Now, on the surface of us, this looks like a pretty good stat. 100% of the time later, when in similar conditions, we were generally bullish. And this is fantastic when you're looking at 2 months later. But the problem is there is another stat that we'll share in just a moment that has to do with the 200 DMA, that is the daily moving average on the Qs, that is the Nasdaq. What is it? I'll look at it in a moment, but depending on how this market reacts and whether it holds under that 200-day moving average for too long, it could be entering into a bear market territory sooner rather than later. Let's not totally get freaked out. We've already seen this particular stat here that we've shared in previous videos to do with this huge volatility that we're seeing right now. And we know that theoretically, if tariffs come off, if we get deregulation, if we get Fed QE put in back in, and that may actually happen over the next 24 hours in terms of insinuation, these types of things could, of course, instantly turn the market to the upside. And that's not even to mention the tax cuts that could be on the horizon. So you've got to remember that while everything looks bleak right now, this is one of those critical points. And we always find ourselves at these areas just before key news. Why? Because if the news is bad, it could push significantly down. And that's why Jerome Powell's coming out after the non-farm payrolls over the next 24 hours. And that could be the most important speech that we've been looking forward to this week, because if it goes bad, well, things could get diabolical very, very quickly. Let's talk about the Nasdaq 100 though and go through some stats here. And this has to do with the 200-day moving average. Now, as you guys have seen several times before, we've hit the 200-day a lot in the past, and it's one of the best in terms of getting generalized bounces. But if things don't turn out to be the bounce and markets actually go down and hold underneath the levels, as you'll see here, latest data from Jason Gopfert, which is only 3 times it's occurred, well, it hasn't been pretty. 2000, 2008, and 2022. Do they sound familiar? Well, at least 2 of them were basically full-on recessions. And this is the problem that we find ourselves in, a very unique period of time where we are seeing significant angst in the markets and, of course, a tale of 2 courses. If we hold underneath the 200-day moving average over the next 2 weeks and we end up down enough, in fact, I'll just go back there and give you the actual stat here. It's if we're 200-day moving average, we're underneath, and we suffer at least a 3.5% drawdown within the next 2 weeks, it will lead generally to a bear market. So, of course, we're looking very closely at how this actually plays out. On top of that, it does make sense because, of course, if we've been looking at the 200-day moving average, which we thought we would hit in Q1, and of course we have so far, it really is a tale of 2 stories. 50% of the time, it's been diabolical, and 50% of the time, it's been okay, although a lot of the returns, even in the okay kind of range, haven't been those exceptionally insane returns that we've seen over the last couple of years. So why does this all matter? Well, it comes back to jobs. Job cuts by reason. Take a look here at the latest chart here from Daily Chart Book, and it shows that this is where the cuts are coming in terms of industries. You've got bankruptcies sitting at a pretty interesting big number there, 16% of the percentage year to date. And of course, Doge's actions so far making up almost 30% of the overall firings going on in the economy. Now, the economic kind of indicators were looking pretty good only a few months ago, but everything seems to have changed. But of course, as we know, it really could be changed just like this with QE. Announcements of tax cuts or deregulation, those things really could bring the market up. And while everyone's freaking out, and rightfully so, we've got huge amounts of puts, hedge funds are at record kind of sells over the last 2 weeks, and we've seen a huge amount of counter to that, which is dark pulls at these levels. We'll go through that in a moment. We do know that this is pretty normal for the market in terms of what tends to happen. We usually see a bit of weakness. We sometimes come down to support levels, and then we often do ramp through into growth over the past 20 years. And this is why it's going to be such an important level. Even if we do sell a little bit further here in markets, we're looking for a very quick snapback to get back above the 200-day and some of the key levels we'll look at in today's video together. Because if we don't do that, yeah, it could turn really bad and it could send us on the recession path. And we've talked about how 6 to 7 months after the rate cut is a decision time for markets. In fact, I've been recently doing some traveling around Australia, meeting some of the guys in the community. By the way, it was awesome to meet you guys, and I'm looking forward to coming around the world and meeting even more people from the community. It's going to be awesome. And of course, we'll talk about that. But actually stay tuned for it, because I will have probably a special live session that I'll put in the comments description down below, where I'll actually do that talk to everybody so you guys can see what's up. Now, Prime Book Global Equities, what exactly is actually going on here? Well, Prime Book Global Equities have shown hedge funds have sold a significant portion across the board, and they've basically made new record over the last 2 weeks, record selling. Now, at the same time, put volume has gone up to record highs. Again, we're seeing record by record by record in 2025. And the last time we saw puts this high was the SPY here, March 10th. Obviously, we did still sell a little bit more than that. September 23rd, which again did make a lower low. So again, it's not unexpected to do this. And March 4th right now in 2025. And what tends to happen is around these huge amounts of freak out put levels, we often can find basing formations. Everyone's freaking out. Sometimes the market can just, get suddenly a bit of positive news and it starts to squeeze incredibly quickly. Retail imbalance also shows that retail traders have been freaking out. And in our weekend video, we'll talk about the latest sentiment reports as well, which are coming in pretty diabolical. Now, why could this be? Well, it's just a change in expectations. Everyone went from incredible froth to all of a sudden Goldman Sachs and many others actually downgrading their estimates on the EPS growth. Now, does this change what Goldman Sachs is saying about the year? Not really. They're still forecasting 7% growth, but we know there's changes with the winds and they'll move it up and down, and they're generally wrong with these particular expectations. But you can see clearly there's something that's happened, a change is in the air over the last 2 to 3 months in terms of there is an expectation for lower EPS growth, and that basically ends up compressing valuations. So that can be a concern. Now, what are the good news bits? Well, the good news bits are, of course, the transactions that we've been seeing, which are massive on both Mag's 7 stocks, which have been around the support line right now, and of course the Qs and S&P. Now, they've all happened over the last 100 points. And the key to this is that we are still within that range. We are still holding around the daily 200 moving average on the S&P 500, the most important read, and we are still holding above the 5,700 line. Now, if we start losing that, as you see over the next 2 weeks, things start to turn really bad. We've also seen clusters coming in of dark pools, huge transactions all over the lows down here when it comes to around 222. And this is on IWY, which is the Russell 200 growth. So clearly someone is transacting large down the lows. It doesn't mean it instantly has to rip up. In fact, they position, sometimes they'll push a new low and then they'll rally it. Or it could still be a sell, although I think, and I did ask you guys yesterday, most of you thought this was most likely a buy due to the clustering of all the positions down near the lows. And I tend to agree with that. It looks like a buy. They could be wrong again. Now, what about Tesla? A new one here that I thought I'd bring up, which is basically the fact that Tesla is getting closer to that magical 250 level. Now, we've suspected that once it gave up kind of really any of these levels up here in the 400s, that we might be targeting down in these areas. And 250 has been at level between 220 and 250 that we've seen a little bit on the put zones. And the reason why that is the largest transactions, or at least some of them, again, look at the cluster up here. It took a little while, but it did end up selling. And down, look at the cluster here. These were buys before the election. Now, this is an important line in the sand for Tesla because there are huge trades that have gone through that level. So this is another one that we'll be watching. Another thing to worry about a little bit here is just the bellwether curve. In general, The markets, as we've been saying all of 2025 so far, it's not the same as 2024. Up, down, and all around, certain levels of fear coming back in. And while we haven't completely dropped the financials yet, which is usually the sector that you want to be semi-terrified of, if that goes bad, then yeah, it's pretty bad because that means debt is going bad. We are starting to see weakness across the board. Now, the problem with this is we have to also take into account certain leads. And one of my biggest issues has been margin this year. And I think all of us agree that too many people are tracing significant gains and they're using margin. And that is causing, of course, pain right now with the up, down, and all around. From someone like Tom Lee, that's always a perennial bull, his opinion, and I also agree with his opinion, is that we could get a Trump put, that is a reduction in removal of all sorts of things that could absolutely load up the market again in terms of turning it bullish, or we could get the resurgence of QE. I can tell you, at least the way I'm tracking it, the last couple of weeks we've seen a slight increase in liquidity. And this is, of course, a good sign if we're looking at the markets. Not enough yet, but if it starts to accelerate, I'll let you guys know. And that could also be a good tell that we're starting to find a bottom in the markets. Now, the worrying sign is, as we mentioned yesterday, the Wyckoff that's formed on the S&P. We're still at 5,700 plus, but we still really haven't activated complete and utter collapse. But we do know that what happens here is going to matter. And if we drop certain levels and we act like this, we're going to be in a major sign of weakness. And all of a sudden, just like that, we could be down 10, 15, maybe even 20% and entering into a bear market. What about Bitcoin? Because Bitcoin's being probably the most volatile, or crypto's been the most volatile with all the announcements coming through. While we just saw the RSI get trashed down underneath 20, which puts it into an oversell. Now, whenever we've seen this in the past, it has often been, again, a kind of temporary, I would say stabilization. If it's happened after a long time of market sideways or even a huge sell, then it can be kind of a basing formation for the markets. And I guess to me, what this is telling us is at least on the volatility towards the downside, we'd have to think that we're getting closer to those significant kind of base levels where volatility might die down a little bit on Bitcoin, even with all the announcements coming up. Don't hold me to that, though, because I know it's been absolutely wild. It's just what's happened in the past. Let's now move over here to the inflows. This is, of course, a delayed data chart from the 5th of March. I will bring up the as of days ones recently. I've found a new source for it, so that's going to be good. But you can see here both were positive inflows over that session, and that makes sense. The market was actually going up. What about the markets from the last 5 days? What is the rotation? Well, I find it kind of interesting that we're seeing home builders finding buy pressure. That's after getting trashed into a demand zone. And it's kind of like that critical demand zone, similar to a 200-day moving average. We've also seen some weakness here, though, in two sectors you don't really want to see it in, which is financials and regional banks. Certainly concerns over what exactly is going on there. Maybe those bankruptcy numbers aren't great as well. Like, we're starting to get those up there. Debts, people taking leverage, maybe not paying it back. There are concerns. For sure. You can see them in the markets. Our favorite sector of the year, healthcare and gold, continues to do best. And as you can see here, the last 24 hours was more of the same. Defensive style market. Unfortunately, semiconductors coming under geopolitical pressure, all sorts of things happening there. So let's have a look at the S&P 500. Let's look at the gamma flows. And we know that the S&P is critical. It is super critical. It has to kind of find buy pressure here. Otherwise, if we drop this area, we could be easily seeing 5,400 with a click of a bit of an issue, and it finds ourselves at this important level. It doesn't mean that we have to lose hope, because as we know, dark pools have been active. We've got puts, which you're going to see in a moment, that are everywhere, like everyone's on puts. And historically, they have been bounce levels. But of course, if they're not, and we continuously see selling pressure like we've been seeing around this area, and it falls through, and we get that 2-week negative, well, the stats don't lie. I mean, there's not many reads, but they're not exactly positive areas. When we have a look at the futures market, and we take a look at that. Actually, I did an update here. I'm not sure why it's not there, but I will give you guys the latest options, high and low levels on X. So you'll be able to see those for today, because you will need them. I think 56 and a 58.12, I think it is. So we'll activate those on X, so make sure to follow us there for those. And what that really will tell you is 68% of the time markets will stay within those ranges. So they can also act as like temporary support and temporary resistance relief. Now, and you might think, oh, the market's down so much after these dark pools, but let's be realistic. The market is down about 2% after the worst buy they've got, and that is perfectly normal for Wall Street to be activating and markets still to push lower. The key here is getting above this line that we've put in the sand. You've got to realize, and we all know this, we're in negative gamma. Every time the market pushes down, it kind of feeds upon itself and can pressure the dealers to actually have to hedge their book off. And as you can see, we're just touching these really critical levels. So even though we went underneath the last low, we hit a key zone, we've found some buy pressures, a little bit of a wick here. We never went above the tweezer of the last 24 hours, and volume is up big time. So there are buyers, there are sellers, and there is, of course, a differing of opinions. Now, when we have a look at the next couple of options expirations, it becomes pretty clear that we have puts everywhere and things have changed. I mean, we are now seeing, if you can believe it, 0 DTEs pushing down to their biggest levels at 55.30. I mean, we haven't even been looking at a 55 put for a long time here. The general one, though, and the consensus here for the 21st of March, but generally in March in general, is 5,700, and 5650 to 5700 is the big level of the next 24 hours. So we really just do not want to lose 5700. If we do, we're going to go 5650. We need to see spiking. And again, so many puts everywhere. Everyone's jumping on it. This is probably the worst time to buy puts in my opinion, but you know, hey, you do whatever you need to do. You can obviously take your own risk management into consideration. Now, why is this important? Well, if you have a look here at Nvidia, we have just found the 110. Now that's under the 115 most traded zone. Not a good sign. Weekly close will be key to a lot of these markets. You know, if we close underneath, but everything, S&P, Nvidia, Nasdaq, that's not really a great thing for next week, and it could pressure us even lower. And as you start to push through, you can start to see, well, 100 becomes a level as well. So 110, big put zone. I'd like to see it reclaim 115, certainly critical. When we go and have a look at Tesla, of course, has changed dynamics a little bit over the last 24 hours. At 250 still remaining the number one strike, though, through the next couple of weeks into all of the OPEX as well. So that basically means each week 250 is well struck. We know it's a key zone from the previous past history, and that can be very helpful when we're trying to figure out what's going on. Now, what else do we need to be thinking about? What is the bonds market doing? Now, of course, we do read this by taking a look at this chart here. And this tells us kind of the options breakout in the bonds market. And I would say, generally speaking, it's not diabolical, not as bad as you would think it would be coming down to these prices. And I find that very interesting because when you look at something like the bonds market right now, or you look at any of these kind of yields as well, they're up, down, and all around. But if we look at junk bonds, let's have a look at junk bonds together. They're not exactly getting destroyed. And this tells me that this is probably more of a geopolitical situation or something that the bonds market deems to be possibly fixable and less of a catastrophic debt issue at the moment. If it turns into a catastrophic debt issue, yeah, it's not good. So we must watch these bonds very closely, and we will be, and of course we'll share it with you guys as we do. I always watch them all the time anyway. What about ITB home builders? Found a buyout. That's not a bad sign. Big volumes down here, so a lot of sell pressure, a lot of buy pressure. Key level being held, and this is important. You want to hold these key levels. And of course, oil got collapsed on, but still hasn't closed weekly underneath key zones either. We have a look at the dollar. The dollar's been getting collapsed on again. I think it's at support. This is a good support line for the dollar. And while my opinion is still that the dollar will weaken as it's being engineered to go down, oftentimes if you actually look at the dollar weakening, it can have a positive effect on some commodities. So we'll talk about that in our weekend video. Stay tuned for it. Make sure to subscribe. There's just so much going on. These markets are interconnected. It's something we do here uniquely together. We look at everything. We bring it together into one cohesive storyline. But remember, this is like a living, breathing thing. There are so many different complexities, but you can see it in the price. And that's why we often say if it's in the press, it's in the price. Ignore what you're hearing. Focus on the key levels, the data, the macro stuff that actually matters. Let's have a look at gold. It's doing well. It's holding its own, stuck in the middle of nowhere land. So, of course, we look for a break up to get us past 3,000 plus, and we look for a break down to possibly collapse gold down to these levels here with 2750 would be an awesome swing zone. Silver climbed higher over the last 24 hours, then came back. Still bullish on silver. Like to see it keep ripping higher. And Tesla is dropping. So Tesla is obviously getting closer and closer and closer to that 250, 245 level. This level down here is going to be, I think, critical for Tesla. And it's certainly got bad press at the moment. But ultimately, it could have a relief rally, especially down here. It's a very heavily traded zone. We'll be looking for it. Speaking of heavily traded zone, Nvidia, no relief, unfortunately. 110. Yeah, it's a put level. But 110, 115, we need to hold this. Even if we go lower over the next 24 hours after the jobs numbers and then we rip higher, that's going to be a good sign if we can get back through 120. But, there's a lot of spec here. I mean, semiconductors are quite sick. And as you guys know, it's not just the semiconductors. If you look at the mags and you look at the Magnificent Seven, it's all on these levels, these incredibly previous resistance, previous demand zone levels. So we don't want to go much lower. If we do, we drop so many key supports, and all of a sudden, that's when the algorithms start going freak out, and we get what we call a broad-based sell. At the moment, if you actually have a look at the SPX, and we load on an advanced decline indicator, and we'll track that here, you'll notice that it's actually not shocking. So this is not a broad-based sell-off. This is a growth-based sell-off, and unfortunately, that growth is the biggest component. So, of course, you're dropping so much percentage of the S&P because you're losing, these big mag style stocks. But if you have a look here, the advanced decline indicator is actually not shocking. Now, if that goes the way of this, we'll be down a lot more very quickly because, of course, that's showing you a broad-based sell-off. That's everything sell. That's a freak out basically in the market. Why we know it's not happening is look at the defensives. This is one of our favorite defensive of the year, which is healthcare. It's boring. It's slow. But guess what? It's been kicking the S&P's ass. And the main reason is because it's deregulation in this case. And we know the insiders are buying. Check back a few weeks ago. Well, rabbiting on about it. We got some good data there, and it's been stronger. Another one is being China. China benefits from the weaker dollar. It's also got lots of stim coming in, and China's really taking this opportunity, and they're just nailing the news every day with, we're going to focus on AI, we're focusing on tech, we're focusing on this, blah, 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 blah. What it's doing is it's basically bringing investment allocation from the US into it. And Europe is also getting investment allocation at the moment due to the defensive spend. So you're basically seeing HSI push towards 25. We're also getting Germany pushing higher. I mean, it's kind of looks like a diabolical market to me, this one, but it is pushing higher. And while I wouldn't be entering into the German market at these levels, you can clearly see that there is flow that's been moving into them. Now, let's have a look at US 2K. No buy. I mean, there's just nothing you can do. It hasn't broken above. It hasn't done what we needed to do. Similar to the S&P, they just have not. They're all negative gamma. They have not been able to get above these levels. Look at the tweezer here from the Nasdaq. No buy because it can go above. If you do, it's a position or an investment or something like that. And what you're starting to recognize here is that we've also got almost downward trend lines forming here on the Nasdaq. And this is great because what this does is it gives us kind of like a line in the sand that we need to break through 20,600 to say the dark pools are buys, things look better. This crazy candle here that looks horrendous. I saw that during the session. I was like, well, we're going to make a new low. Of course, we did. That was a horrendous candle. When that comes through, yeah, it's going to end up with where we're at, guys. And we're down in these really important areas. I mean, this daily 200 on the Nasdaq, it couldn't be more important how it moves around here. And as we saw at the start of today's video in the data, if we lose this level and then we start dumping further, that has some very unique times with it, and they're not exactly great. And the problem is that with the leverage, with the other things that are in there, I mean, it could be, kind of bad for markets. Speaking of other things that we need to look at, we've got here Ethereum, and Ethereum obviously getting some good news about people purchasing it. Certain, of course, buyers are in it, but just like everything, sentiment is what we call shot at the moment, and that is causing a lot of concerns through the crypto world. We must see Bitcoin regain, and it just flash sold while I was recording here. Went down to like 84 or 85,000, yeah, so we were in the 84s, and I was just lining the 61.8 up to say it has to hold this level. And yeah, it ended up finding how many thousand? 230,000. I mean, it's volatile. It's volatile. Look at the volume dump. We hit this level here, It's key. It really needs to hold. We do not want a new lower low. No new lower low, please, because if that happens, starts to break structure, and we really need this one to break the high, because this is all like almost diabolical in terms of price action. The reason why is because it comes off what many people will call a double top or some form of Wyckoff distribution. So to destroy Wyckoff distribution, what do you have to do? You have to break the highs. And if you don't do that, then all of a sudden it becomes a self-fulfilling prophecy. And the other stock that we've got that problem on is, of course, Nvidia. And you'll notice here we never made a higher high. We got the gap fill, which we thought would be a good TP before the earnings, and then it just got crushed back down. And that's a Wyckoff distribution. So because we've got that, we're now in a lower low. Markets have to start recovering. Otherwise, we've really got what we would call a pretty significant degradation of the charts. And a lot of you guys in the comment section have been calling this and saying, you know what, this thing is absolutely cooked. Look, there's been a lot of bearish kind of dumps. I would say that the last 2 years, they weren't that scary because you could always see a way out. This one is just because you're always higher. So when you're higher, your higher valuations, things are a bit more scary. And I know that margin by retail is just massive, and we need liquidity. We need the Fed, basically, the Fed put this market. So if they do, that's going to be pretty good. And of course, we can keep driving high.